Welcome to Stock Market Investing with the ARMR Report. This is the morning meeting for ARMR Insiders. It's Monday, the 24th of May. Thanks for joining me, everybody. Starting with the Risk Monitor, nothing's changed yet, but I want to share with you my thoughts on if the market does X, how it will change the Risk Monitor so you know how I'll be investing. So don't forget, of course, I'm sharing with you information I use to manage my own personal capital. So I view the ARMR Report as a guide to let you know how I'm putting capital to work. I like to share the ARMR investing way with you, which is that three-stage process. Build our whiteboard, which is fundamental research. Use ARMR algorithms to manage our risk on, risk off decisions, and then tie it all together with a sound stop loss process. And if you put all that together, my hope, my dream is that the 30 years of experience I've had doing this that I'm sharing with you will hopefully make you a better steward of your own capital. That's what I'm trying to do. Don't forget, ARMR stands for Algorithmic Risk Management Research. So we start and end every decision on this desk with risk management. There's four primary indexes we use: the S&P, the NASDAQ, the Dow, and the small cap. And then there's four secondary indicators or indexes we follow: momentum, value, IBD 50, ARC Innovator. What we're looking for is confluence across all eight. We will go green if we get confluence across the four big indexes. When we go green on a four index entry point, it's going to reduce my enthusiasm for how aggressive I get in the market and what type of stocks I buy. Information makes money. We all know that. Institutions make markets. And so our job is to get in front of the institutional flow of capital. And that's what the algorithms are for. It's a probability algorithm. It's a percentage algorithm. So when we get confluence across the board, there's a high degree of probability that the institutions are putting a lot of money to work. And so we get busy. Institutions generally don't put money to work in one day. You're managing your own portfolio and you might put all your money to work in one day. Institutions have billions of dollars to run. They couldn't possibly put it to work all in one day. This is why you get an uptrend that lasts for months, because they're putting money to work, boom, 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 and they use big moving averages to fill out their position. So only the individual investor, momentum chaser who doesn't really understand the market is chasing stocks that are 3-4 standard deviations above the 200-day, above the 50-day. The institution's not buying up there. They'll wait for that blow off to end, the crater to happen, and then they come in and start buying. Example, Coinbase came public, started trading, it was $380 a share. Okay. What we just saw, I read this over the weekend, is that the ARC Innovator funds bought 1 million shares of coin, I think on Friday. Right? Institutions buy weakness. They don't chase strength. They might get a little piece. They might get a taste. They might put a little bit. But the real buying they do is on weakness. And that's what we're trying to do here. That's the ARMR Report, right? The whole basis of what I'm trying to do with you guys is to share the process of buying ARMR value entry points. And to that end, let's just enjoy a little chart porn for Monday morning. You ready? Here it comes. Here it comes, right? That is an ARMR value entry point extraordinaire. Now, I don't know if Biohaven is going to go to the moon. That's not the point. That's not the point. Your job, my job, is not to guess which stocks are going to go up, 300-400%. I don't know. Our job is to put ourselves on the right side of probability over and over again when reward's worth risk. Cut the losses quickly that don't work and then stay on the stocks that skyrocket. The best way to do that and protect capital at the same time is to find value entry points. So this is a value entry point. Double bottom. So it broke below the 200-day moving average. This is the green line here. Made a double bottom, closed back above all the moving averages. We were buying it right here, right? Now it's broken the downtrend. This is the type of a setup that could go vertical. Now, if it reverses, it breaks back down, our stop's going to be tight. and we'll step aside. It's okay. So this brings me to another point. In some markets, we're going to put positions to work. They're going to skyrocket. It's going to be easy. This was last year. So getting back to the risk monitor, what will get us to go green? Last week, the NASDAQ 100 and the small cap index gave us a risk on buy signal individually. Now, those individual signals don't have nearly as high a degree of probability of success as confluence. So I don't run out there and start buying everything because we get one or two indexes that go positive. But what we have now is a setup in the next 24 to 48 hours. We need to see the S&P and the Dow, boom, give us the risk on entry point as well. Then all four of the big guys within a 72-hour window. It's better if it happens in a 24-hour window, but we give it 72. If they all go positive like that, then I submit to you the probabilities are very high that the market's going to try to go to an all-time new high. How would I fill out the portfolio? Well, if we look at the ARC Innovator, okay, that's a destruction of capital that needs time to set up a new base. So there's no way the ARMR algorithms are going to go positive on that index during this upcycle. If we get an upcycle, we're not going to have a risk on buy signal there. Okay. And it's possible the IBD 50 can give us a signal, but that's not really the right pattern. But if it closes back above the 50-day moving average, it might. Okay. And the momentum index, let's see what's going on there. Now that's a nice looking cup and handle right at the 50-day. So if that takes out the high of Friday, my guess is that'll be a risk on buy signal momentum. I'm curious what the value index looks like. Value never broke down. Value never broke down. So if it takes out the highs really of last week, it will actually continue to be a risk on signal. We took it out of the portfolio because we went risk monitor red. We sold everything we had, but it never broke below the 50 days, you can see. And same thing with the Dow. Never broke below the 50. And this brings me to my last point. I know all the negatives. But have you ever been short? Have you ever short? Has your portfolio ever been short? Have you ever had a bunch of puts in your portfolio? Do you know what it feels like when a bunch of bad news comes out that you were predicting? The innovator stocks are collapsing. The cryptocurrency drops 50% in a week. So risk assets are burning at the stake. You're sure you're going to make money in your puts and your shorts. And the market doesn't go down. Do you know what that feels like? I know what that feels like. I've been there before. Okay. And quite frankly, that's one reason why I don't ever short overnight in a Fed manipulated market. It makes no sense. Now, I mean, if you could pick off an individual name, you want to go short Tesla because you think it's a scam and the whole thing's going to implode, then I mean, obviously you can make money doing that. But from a broad sense, I don't short indexes. I don't get overly short. And the reason is you can be right all over the place, but when the Fed's manipulating the market higher and there's a support by the Fed, it's very hard to make real money. Let's go look at a couple of names at the top of our whiteboard. I was thinking about this over the weekend, and I really want to get shares of Ford in the portfolio. That's just a sick chart pattern. Okay, so I'm going to see how that thing behaves and see if I can't find it on weakness. Who knows? I may not. I mean, it's another 1% today. So if it just runs away from me, I'll have to wait for the next consolidation there. I'm not chasing anything. That pattern looks great. I want to add shares of Cloudflare to the portfolio. We already have CrowdStrike. We already have, which is breaking out. We already have FireEye, which is breaking out. Okay. So what we want to do now is we want to keep leaning into these cybersecurity stocks, and Cloudflare is my next favorite, followed by Tenable. I was on this conference call last week. It's a thin stock. It's a smaller cap stock. They're just killing it. I think I'm going to have to get a piece of that. Okay. Couple of big cap names that are on my list to to consider. I think if the market's going to break out, I'm probably going to buy back shares of Microsoft. So we added shares of IBM last week. Right? I'm looking for, this is what I love about a down market. The market went down to the 50-day moving average. Which stocks did not? IBM held the 25-day moving average. That is relative strength. It's as clear as it can possibly get. I still have my eye on steel stocks. I think the story is great. I think you have to buy them on weakness. I think you have to buy them when people like Jim Cramer and guys on CNBC hate them. Okay, that's when you have to buy steel stocks. You can't buy them when they're running. So they're on my list. They're down at the 50-day. I have them as an idea, and I'd like to own maybe some shares of Tech Resources, which is a copper idea. Okay. Just for the fun of it, I might trade Moderna again. We traded it last week on the live trading desk. We made some good money. I might go at it again now that I have this shot in my arm. Let's see if they can pay for it. Oh, and don't forget, the last one's PayPal. This might go in the ARMR Invest portfolio. Okay. This breaks out above the high of Friday, taking out the 50-day moving average. That'll be a risk on entry point using the ARMR single stock algorithm. I'm pretty sure that'll fire. All right. So those are my thoughts right now.